Imagine a world where factories quietly reroute from one continent to another. Politicians call it opportunity. Corporates call it diversification. The big question, is this reshoring a durable industrial shift or a headline that outpaces reality? Hi, you're watching Economic, no spin, no hype. In this video, I'll map the confidence-driving moves to India, show the 3 corporate decisions being made now, explain the practical gaps those decisions meet, and give you 3 concrete signals that tell us whether this is real or still a headline. After supply shocks and geopolitical friction, companies and governments share a simple story: diversify supply chains, reduce single-country risk, and tap India's scale and low costs. Executives say India offers demand, low labor cost, and policy support. Governments say we'll build parks, give incentives, and train workers. That alignment is powerful, and it creates momentum. The rhetoric turns into action. Large electronic manufacturers and EMS firms sign long leases and MOUs. Automakers expand regional plants, and suppliers begin scouting production hubs. These are 3 repeatable corporate moves we're seeing now. 1. Capacity commitments. Firms commit CapEx for assembly lines and warehouses. 2. Supplier remapping. OEMs start qualifying local vendors or relocating Tier 1 suppliers. 3. Local partnerships. Firms tie up with local industrial groups and training providers for skills pipelines. Momentum meets complexity. Building world-class factories requires more than land and incentives. You need ports that turn quickly, steady power, logistics, predictability, and a cluster of component makers. India has strong advantages: a large domestic market, skilled engineers, and rising supplier activity. But some ecosystems are still nascent for advanced electronics and semiconductors. That matters in timelines and unit economics. If companies and governments coordinate effectively, outcomes are powerful. New manufacturing hubs, high-value jobs, export growth, and diversified global supply. If execution falls short, outcomes can be delayed projects, higher costs, and reputational hits. The difference often comes down to 3 practical capabilities: infrastructure delivery, supplier depth, and skills. That's where the rubber hits the road. Don't guess, measure. Watch these 3 signals carefully. Signal 1. Supplier density. Are Tier 1 and Tier 2 suppliers setting up within the same industrial corridor? Real cluster formation, not isolated plants, is essential. Signal 2. Operational infrastructure. Are ports, power contracts, and logistics systems operating at target throughput? Signed MOUs are useful, but operational proof containers moved, uptime % is the signal. Signal 3. Skills and O&M investments. Are lead firms investing in training academies, maintenance teams, and R&D locally? Long-term success requires a workforce that can run advanced lines, not just temporary hires. If 2 of these 3 signals show sustained progress in a sector, treat the reshoring as credible. Otherwise, it's early momentum, promising, but not yet a complete switch. Reshoring to India is real and already creating economic opportunity, but it's not magic. The winners will be the firms that pair capital with local suppliers, core infrastructure contracts, and training programs. Governments that deliver paved roads, power, and permit certainty will get factories and jobs. Which signal worries you most? Supplier depth 1, infrastructure delivery 2, or skills 3? Comment 1, 2, or 3, and I'll pin the best replies. Subscribe to EconomiQ for daily explainers that cut through hype and show you what actually matters.